though, not so sure that we're going to get that. Thierry Wizman is global interest rate and currency strategist at Macquarie, and he joins us now. Thierry, thanks so much for being with us. Lay out your base case for how rates are likely to unfold this year.
Well, the Federal Reserve, I think, has already made a determination that it wants to cut the policy rate. That was evident in the dots that were issued with the summary of economic projections at the last meeting in December. And you also have a lot of commentary from Fed officials saying that they expect to cut rates as well. The question, of course, is how much and when. I think that the problem with the question of when is that we really have more steps to go before the Fed can feel comfortable or even able to cut rates. We came into this year still with a tightening bias, with at the FOMC. In other words, they are not yet conveying officially that their bias is to cut rates. So we still have to go from a tightening bias to a neutral bias. And then we have to go from a neutral bias to an easing bias. And then presumably after that, we can cut rates. Now, the good news is that we don't have to wait a year. We think that this is probably another 5-month wait. At the same time, to the extent that the markets are thinking that we're going to see the first rate cut in March, we think that's too early. 2 months from now is still too early in view of those steps that the Fed needs to take.
Okay, so that's how you differ on the when rate cuts appear. Do you differ on the magnitude that is expected to be delivered over the next year?
I think so. I think that we do differ, not radically different. When I last looked at where my colleagues were, they were thinking that we could see somewhere on the order of maybe 150 or 175 basis points of cuts on average. There were about 3 houses in addition to ourselves that think that we could see more than 200 basis points. So we're in the minority, but we're not alone, if you will. Yes, we do think that after the Fed starts cutting.
No, continue your thought.
We do think that after the Fed starts to cut sometime in the middle of this year, the rate cuts will come aggressively and intensely, and we may see 200 basis points, if not slightly more, of rate cuts coming this year, but it's going to be back-ended in the second half of the year.
So given this, do you get a sense that things are then being mispriced? Are there assets that are being mispriced? Do you need to take another position on the U.S. dollar if the markets are not really looking at the path of rates correctly?
Well, there's a lot of assets we can be talking about here, obviously. I think in the case of the dollar, yes, we could see some dollar weakening against the majors, against the euro, against sterling, against the yen, against the Aussie dollar, if our view of the U.S. economy and the subsequent rate cuts by the Fed pans out. In other words, a softer U.S. economy than the market consensus currently surmises, and also a faster pace of rate cuts in the second half than the market currently surmises. If those things play out, then the dollar should weaken, marginally, albeit, but weaken nonetheless against those majors. As far as the bond market goes, I think that 4% for the 10-year yield is fair right now. But of course, if our view pans out, we could see a retest of those 3.5% 10-year yields that we saw earlier in 2023 for the U.S. Treasury 10-year yield. As far as stocks go, I think that clearly the fact that rates will be coming down is going to support multiples. But we have to keep in mind that this is in the context of a slow economy. Pricing power will diminish. We do expect inflation to slow dramatically throughout the year. So operating margins may feel pressure, and it's not exactly clear how that will balance out in terms of stock valuations. But it's clearly not a situation where we expect higher multiples higher operating margins, higher profitability growth, certainly not the excesses that some people in the marketplace are prospecting. We don't expect that. Multiples should be supported, though.
Well, I wonder, to your point, instead of cheerleading for 6, if the market should actually root for 3 rate cuts, because that means that the economic backdrop is not so severe as to warrant that many.
Yeah, there's certainly something to be said for a stronger economy and more pricing power supporting operating margins at U.S. companies this year. Keep in mind, though, if the Fed does cut aggressively and the dollar weakens even further, it could help profits as well for companies that produce overseas or sell overseas that are based in the U.S. So, it really is a question of looking at much more than just two variables, i.e. growth and inflation. There are a few other things out there, and rates, of course, that will determine margins for U.S. companies this year. But our view is that multiples could be supported, but it's unlikely in a slow economy that margins will be supported.
Of course, there's a lot of discussion about rates, but the Fed has also, governors have started to talk about the balance sheet and how the Fed might use that as a tool. What are you reading from the comments that they are saying about how they might, use the balance sheet as a monetary policy tool?
Well, it seems that they don't want to confuse the market, which means that once they start to wind down or slow down the pace of quantitative tightening, that they will likely do it at the same time that they are starting to cut interest rates. That's altogether possible. In fact, that's the signal we've gotten from Fed commentators so far, that these two things, these two events will be somehow intertwined to take place at the same time or around the same time. Look, as far as what the Fed wants to do with its balance sheet, it really is a question of how the staff is going to estimate the requisite amount of reserves that the commercial banking system in the U.S. wants to keep on its balance sheet. And that analysis is probably not complete yet, but when it is complete, and I think we're going to get some sense of what the Fed is thinking with regard to reserve demand at commercial banks, then we'll get a sense, of course, of what the target for the Fed's balance sheet is. And from that, we could infer or extrapolate what the pace of the wind down of QT will be and when it will end.